You may be wondering how mortgage rates are decided. Obviously, you want to make sure that you get the lowest rate possible. But how is that determined, and what can you do to make sure you have a low rate and low cost? Hello, this is Selland with Signet Mortgage. In this message, we'll share how mortgage rates work. There are several outside factors that affect how mortgage rates are determined, as we've seen over the past few months. However, there are your own personal factors that can have a significant impact on not only rates, but the cost of your loan, and maybe impact even if you can qualify. The better you understand your qualifying factors, the better the interest rate and lowest cost you'll get. Mortgage rates are affected by the overall economy. When the economic outlook is good, rates tend to increase, and rates fall when the outlook is not so great. Mortgage rates are determined by many of these economic elements: the inflation rate, the pace of job creation, and whether the economy is growing or shrinking. The Federal Reserve doesn't set mortgage rates, but it does affect mortgage rates indirectly. The Fed controls short-term interest rates by increasing the overnight rate that banks can charge each other for holding funds or decreasing them based on the state of the economy. While mortgage rates aren't directly tied to the Fed rates, when the Fed rate changes it, it's an indicator of the overall direction of rates, and mortgages usually follow suit soon afterwards. The Federal Reserve controls short-term interest rates to control the money supply. When the economy is struggling, as has been the case during COVID, the Fed lowers rates, putting money in the economy. These are not the rates given to consumers, but the rates at which banks can borrow money to lend to consumers. When the Fed decides they need to tighten up the money supply, they raise the Fed funds rate, which doesn't directly increase mortgage rates, but eventually is filters through to mortgage rates. One more detail: mortgage rates are directly tied to mortgage-backed securities, which are traded every day in the financial markets. It's important to be connected with a loan officer that understands how the market really works and can provide guidance as to when to lock a loan and the best strategy for your transaction. Which personal factors affect your mortgage rate? You certainly cannot control the economic factors of mortgage rates, but you can most definitely control your own personal factors. Let's dive into what you can do to get the best mortgage rate possible. Beginning with your credit score. A high credit score means you're less of a risk to lenders. A high credit score shows you pay your bills on time and don't overextend yourself. When lenders pull your credit, they see you as a responsible borrower with a low risk of default. This leads to lenders to give you a better interest rate because there's lower risk. And when you have a low credit score, lenders, it's the opposite. They often change the interest rate significantly because you're at a higher risk of default for the mortgage. A low credit score indicates that you may not pay your bills on time or that you have overextended yourself. Taking steps to check and improve your credit will put you in a better position to get a lower rate. Maximizing your credit score or improving a bad credit score is a whole different video, and it's not something you should try and do on your own, and I wouldn't recommend you do so. And I wouldn't recommend debt consolidated providers. They're not good. Give us a call. We can certainly get you started. The other is loan to value. The more money you put down on the home, the more the loan to value is lower and less risk for the lender. When you put a little bit of money down into the home, you have less incentive to keep paying the mortgage when times get tough. If you have your own money invested, though, you're more likely to do what's necessary, anything that's necessary to make good on the debt. Lenders charge higher interest rates when there is a higher risk, which means if you put more money down, you have more to lose. Another factor lenders will look at is when raising your risk is if you intend to occupy the home. Lenders like it when the property is your primary residence, which means that you'll be living there, and interest rates are usually lowest on primary residences because it's where you live. You're more likely to make your payments on time because you don't want get in trouble about and possibly lose your home. Interest rates are higher on second homes or a vacation property, and even higher if the home is an investment property. If you have a second home or investment property and you have financial issues, you're more likely to default on that mortgage, putting the lender at greater risk. So they take greater risk, they charge for it. Bottom line is that both market and personal factors impact your mortgage rate. While you can't do anything about the market factors, you can control your personal factors. Be sure to take care of what you can control about mortgage rates by looking closely at your personal factors and make them as solid as possible. Always be sure to work with a licensed mortgage professional and get your questions answered. I'd be happy to help. Thanks for watching. This is Clay Selland with Signet Mortgage. And if you or someone you know is looking to buy or refinance a home or just get questions answered, please reach out to me at the email and phone numbers and stuff that's right below. And I look forward to helping you get into the house of your dreams and helping in any way that I can. Thanks so much.